Are you an early stage founder revolutionizing the future of retail? Then you're in the right place. My name is Sapna Shah, and I'm an angel investor investing at the pre-seed stage in retail tech, e-commerce, marketplaces, and digitally native brands. I'm also the founder of Retail X Series, an ecosystem to help early stage founders in the retail sector. Retail X Series includes events, a YouTube channel, a Slack community, resources for founders, and this podcast. And in this podcast, I interview founders, investors, and experts in the retail space, and we dig deep into the tactics around key topics that early stage founders want to hear about. Welcome to the Retail X podcast. Hello, everyone. Welcome to the Retail X Series podcast. I'm your host, Sapna Shah. Today's episode focuses on best practices for pitching a VC, particularly at the early stage. Our guest today, Mac Conwell, is the managing director of RareBreed Ventures. Mac will give us his advice, tips, and best practices for pitching VCs at the early stages. Welcome to the podcast, Mac.
Thank you for welcoming me. Happy to be here. Looking forward to having a fun conversation.
Same here. So let's get started with some background. Can you start with telling us a little bit about yourself and what you've done before launching RareBreed Ventures?
Absolutely. So my name is Conwell. Everybody calls me Mac. If you follow me on Twitter, it's Mac the VC. The short version of it is I'm a software engineer by trade. Spent several years as a government contractor, fresh out of school, supporting the Department of Defense here. 2010, started my first startup with two of my best friends. At that time, I didn't know what a startup was. I didn't know what VCs were. And we were a team of 3 engineers just trying to figure this stuff out. Ran that company as the CEO for 4.5 years, went through 2 accelerators, a pivot, and eventually sold that technology to the division of a Fortune 100 company. Started another company after that, raised some money. That time around, and that one didn't work out. Go figure. The time I raised money was the time it didn't work out. Ended up having a stint at a marketing firm before getting a job working for the investment arm of the state of Maryland. While there, I worked for the seed investment team, and then I started the pre-seed fund specifically for women and minority-led startups. It's the first and only state-backed pre-seed fund for women and minority-led startups in the country. And then I left that job to start RareBreed Ventures, pre-seed to seed fund based here in Baltimore, investing in companies all over the country.
Great. So now tell us a little bit more about RareBreed, kind of what your investment focus kind of sweet spot is, your typical check size. Are you planning to lead or follow? Do you follow on? Kind of a little bit more about how people can think about RareBreed.
Yeah. So when we say we do pre-seed to seed, it's really anything sub 10 million post-money valuations. We'll go higher than that on occasion, but generally that's the sweet spot. Investing in companies primarily outside the major tech bubble, so outside of Silicon Valley, New York, and Massachusetts. We still invest in those areas opportunistically, but that's not where the bulk of the companies we'll invest in will come from. We're industry agnostic. We don't do life sciences. So it's just not the skill set of me or the team, but we'll do just about anything else. But we care about 2 critical things. If you're a software or tech-enabled company, we like to see a clearly repeatable or unique customer acquisition strategy. You don't have to have a lot of customers, but you need to know how you get your customers. And then we also like physical products that are typically in consumer markets that have lacked innovation over the last 10 or more years, the last decade. Because those 2 founders tend to be out-of-the-box thinkers and out-of-the-box problem solvers, and that's really what we're optimizing for. And our target check size is $250,000. A little bit larger than what you typically see at pre-seed, but that's where we like to be.
Great. That's really helpful for context. Thank you. So before we get into the nitty gritty of this episode on kind of how founders should be pitching VCs like yourself, let's talk about what you're seeing in terms of seed and pre-seed rounds. So you're based in Baltimore, but you invest all over the country. What are you seeing right now in terms of round sizes for pre-seed versus seed? And I know this is constantly changing, but what's your take kind of at this moment? We're speaking in December 2020. What's the size of a pre-seed round versus what's the size of a seed round?
Different people have different definitions of this, right? So it really depends on who you're asking. For me, pre-seed rounds, you're typically raising less than 750,000. Right around 500,000 is kind of where you'll see pre-seed rounds, where your valuations are typically lower than 500 million post money. Where seed rounds, you're seeing people raise anywhere from $1 million to 4 or 5 with valuations as high as like, 25, 30. It's a little weird in the market right now because there's a lot of different, they're not different stages, but there's like these additional rounds that people are calling. You'll see people raise a seed round, then you'll see people raise like a seed plus before they do a series A. So like you'll see somebody like raise a seed round of 1 million and then go ahead and raise what they'll call like a seed plus of like 2.5 or 3 before they go raise a series A of 5 million plus, right?
Yeah.
But that's, I don't know how long that's going to last or how long we'll see that. But it's been interesting to see these smaller rounds happening quicker so companies can keep that flywheel going and keep money coming in.
Yeah, and I think, it's funny that you say that it's different and everybody has a different definition, because I think you'll get a different answer from an investor that is based in Silicon Valley versus New York versus Baltimore, for example. So thanks for sharing kind of your perspective on that, because I think that helps give our audience a little bit of context. So now let's talk about what investors want to see from early stage startups. What is the most important thing to you when evaluating a startup at these early stages? Like, what are the things you focus most on?
I'm going to give a very investor answer, and that's just so I can orient everybody who's listening, right? Because, when people ask investors what's the most important, some people expect you to talk about the market or the team, or all this other stuff. But if we're going to be 100% honest about what investors are looking for, and really this comes down to like what the job is, the most important thing for me when I'm evaluating a company first and foremost is, can I see a pathway to this company being worth $1 billion sometime in the next 7 to 10 years, maybe a little longer, right? And the basics of that is, can I see this company get into $100 million valuation and then $100 million in revenue? So if you can get to $100 million in revenue, 10 extra revenue can get you to $1 billion valuation. That is the number one thing for me. I have to believe that every company I invest in has the potential to be $1 billion outcome. If I can't even figure out the pathway to that, then I can't make the investment, right? And that's because, we as VCs are professional investors have to go unicorn hunting. And, some entrepreneurs and people get up in arms about, well, why you only invest in unicorns? There's other great companies. You're right, there are. But unfortunately, most companies don't make it, right? And most companies aren't going to return capital. And the return capital means, in general terms, that your company either gets acquired or goes public. Those are the only two ways, generally speaking, that a VC ever sees returns from a company. That's actually a really, really high bar. And to do that over a 7 to 10 year time span is yet again a really high bar. And I'm speaking from the terms of an early stage venture capitalist, right?
Mm-hmm.
And so because I know in general terms, most venture firms, 70 to 75% of the companies they invest in are not going to return them any capital. That means the 25% that does has to have returns so far beyond any like relative standards that every company you invest in has to have the potential to get you there. So as long as you get one, you can have a successful fund. And so because of that, that's kind of the starting point. And that's just a function of the economics and the way this industry works, right? Now, once we get more tactical past, do I believe you're in a large enough market and you're the right teams doing all the things you need to, where I could see, there's a pathway to you getting to be worth $1 billion one day. And then we come down to, cool, you got there. Now I really want to understand, and this is very much specific to me and the team at RareBreed, is I want to understand how you think about customer acquisition and customer retention, right? How do you think about getting your customers? How do you think about keeping your customers? How do you think about your customers' experience on your product and how that experience affects the way they interact with the product, right? That is critically important. And that's important to me because, having been in this space for about 10 years now, a little bit longer now, as a founder and now as a VC, I've seen tons of products that are way better than what's on the market, like tons of them. And the problem is, time and time again, these companies fail because the founders never quite figure out how to attract the customer base. So even though their product's better than what's on the market, they never figure out how to acquire the customers, and ultimately the companies end up not working out. And so having seen that, the founders that I've seen be really successful in this space are the ones who kind of figure that out, or are at least constantly thinking about that. They're constantly thinking about customer acquisition and the retention. And those founders, tend to try to be as innovative and unique in their customer acquisition as they are in their product. And so then we really look at that. And then after that is the founder. And so a lot of that for me goes to the founder and the way the founder thinks about approaching the problem they're solving, and their knowledge of the problem, their passion for the problem, the experiences they've learned. Founders being able to talk me through of the things they've learned throughout the process from their customer base and how that's led to tweaks in their product or tweaks in their solution. Always big things for me. So yeah, that's kind of like a starting point.
Wow, that was a lot to unpack there. So I am really glad that you talked about the customer acquisition piece, because I couldn't agree with you more that is sort of a critical thing that a lot of times founders don't focus on in those early days. They're so focused on product. So thinking about that, how much sort of sales or customer traction do you really expect founders to have, particularly when they start raising a pre-seed round? Do they need to have kind of metrics at that point, or are you more looking for that path to customer traction?
So for me, it's going to be more being able to show some traction. So like very rarely will I ever invest pre-product or pre-revenue. Almost never pre-customer, right? Like you could be pre-revenue and not be pre-user or pre-customer. And so, and people get upset about that, being pre-seed. But generally speaking, very few companies are ever going to raise any professional capital pre-product or pre-revenue. It just doesn't happen that often. And one thing I don't think founders understand, and enough founders understand, is when you see that TechCrunch article from a founder who raised a bunch of money pre-product or pre-revenue, 9 times out of 10, they didn't raise that money because of the product itself or the business itself. They raised that money because of their network, right? And so if you don't have that network, you cannot compare your business to them, right? I have founders all the time say, well, I don't have as much traction, but I'm further along building my product than this company that's a competitor that's raised a bunch of money already. Well, that may be true, but that doesn't mean your competitor's business that they raised a bunch of money for is good either. All it means is that they happen to have a network of people who are willing to give them money that early, right? Their network that they have in the space gave them the ability to raise capital. That has nothing to do with the business. Those are two different things, right? And so when I'm looking at a pre-seed company, and every situation is different, right? Every industry is different. Every business model is different. But, typically looking for, some traction or some sense of understanding of traction, right? And so I'm going to look for, are you gaining customers, and are you gaining customers on a regular basis? And is your customer base or your user base continuously growing? Or do you at least have the ability to grow a fairly robust pipeline, and you understand your sales cycle really acutely? This is particularly for like a B2B company, right? Or ed tech company. Like, do you understand that sales cycle of selling to universities or selling to these B2B customers? And do you have a pathway to shorten that sales cycle and things like that? Being able to talk through all those things becomes really important for me. And again, like I said, you don't have to have a lot of customers, but the more the better. And so I can give 3 examples of how this could look and feel. So one, there's a company creating a tool to help online businesses manage sales teams, right? They're pre-launch. They have a product, beautiful product. They haven't launched. They don't have any revenue, but they have a pipeline of like close to 100 customers. From that pipeline, they're going to do a closed beta with 6. Of that 6, 2 of those customers are 2, top tier firms that everybody knows that are worth billions of dollars. And within their pipeline, they have several others similar to that. And so when I asked the founder, like, look, You're really early in everything, but this is a really unique product. You're solving a real problem. Talk to me about how you built out your pipeline. He said, oh, we used the beta version of our product. They use their own product to get their customer base.
Right.
It's interesting. That's unique. Something I can get behind. That's scalable. Not to mention, this is also a third-time founder in his last company he sold to TikTok.
Yeah, not bad.
Not bad, right? That's a different outlook that allows you to make an earlier investment, right? On the flip side, we had my top performing company was a founder building a product in a space that wasn't very interesting at all. Literally, the space he was building his product in, didn't have the ability to have venturable returns. But the founder had figured out how to get 25,000 users in his first 3 months of putting his product live. Right. And when I asked him how he got the 25,000 users, he used a hack on Venmo where he would send people a penny, and for giving them a penny, he put in a message that told them to use his product to get more money. And that was the moment I knew that founder was going to be one of the smartest people I ever met. He just so happened to be 17. Right?
Oh my goodness.
And that's now a fintech company doing really great. And then on the flip side, we have another company that we invested out of the state of Maryland, where when I met the founder, they were only 3 months in. They were really early, and they were in another space that I didn't really care for. But when I met him, I told him that he was too early, and I explained to him what being early meant in the world of VC. He got really mad, so mad to the point he cussed me out, and then cussed out like every VC he could think of. But I understood his frustration, right? I had been a founder. I had been there, He's like, I'm making money. I'm only 3 months in, but I got a lot to learn. Aren't I early? Yes, you're early. But when we say early stage, it's more in terms of early in terms of revenue and traction, not in terms of how long you've been running the business. You'd be running a business for 5 years and you'd be an early stage company in terms of your fundraising, right? And so I followed the founder for 18 months, trying to give him some advice and help him along the way. And at some point he went dark on me. And so I would only talk to him when I was seeing him at events. And one day I met him at an event and I was like, hey, I haven't heard from you in a while. How you doing? He's like, well, you keep telling us we need to get customers. So we've been heads down. We're doing 800,000 in GMV, or we're going to end the year out 800,000 in GMV. We now, instead of only getting 10% of every transaction, we now get 20, and we're creeping up closer to 25 because we figured some stuff out. I'm like, cool. And then he said, and I was like, so what did you figure out? You figured something out. He's like, well, we realized that if we market to people around 3 life events, that precedes them needing our service. And that was intriguing. I had never heard anybody in his space ever say anything like that. Mm-hmm. And that is a model that's scalable. And so that's something I could get behind, because he's in a space where there's a lot of business models where these founders get some success that's a false positive. And what I mean is, you'll see things like buy a beer with a QR code, or find the hottest party, or find the barbershop or stylist, or get me a cleaner for my Airbnb. There's all these businesses that have these almost hyper local models. And really what it is they're business models where a really good founder will just hustle their butt off and get all the customers in their local area, right? By going door to door and things like that. And they'll start to generate some decent, revenue coming in. They get to $500,000 to $1 million in revenue because they got their local city, or maybe even their state, and maybe a tri-state area, right?
Right.
But then when you ask the founder, okay, how do you do what you did in Baltimore, Maryland, and recreate it in Austin, Texas? And then they're well, I have to go out there, put up a team, and that doesn't work. That's not scalable, right? You're going to end up moving too slowly if you go that route. And that's why a lot of companies like that, who start off doing pretty well and they'll get a lot of accolades locally, never make it because they never fundamentally figure out a scalable way to get their customers. And so, he was in an industry that was very similar, but he figured out a way around it. And that was really intriguing for me. And,
right.
He's our second best performing company.
Wow. That's a great story. I appreciate all the context around this, because this is really helpful, I think, for our audience. But now I want to move into some of the more tactical pieces of actually pitching and hopefully getting an investment from a VC like yourself. So How should the first meeting with you go? Do you want them to kind of present a deck, just have a conversation with you? Tell us a little bit how you like that first meeting to really run.
Yeah, for me, I tell found and everybody's different on this, right? People have different opinions on it. For me, though, I tell founders like, hey, it's the first meeting. Almost no investor's ever going to say yes or write a check in the first meeting, right? So this is really just a chance for us to get to know each other. You can ask me questions, get to know a bit about me. I'm gonna ask you questions to get to know a bit about you. I leave it up to the founders if they want to use a deck or not. You don't need to go through a deck with me because I'm going to ask you the questions I need to get the information on you anyway. So whether you have the deck or not, like I'm gonna get the things that I need so I can understand your business and where you are. But if you feel more comfortable pitching or talking to me with a deck, that's fine. I just want to bring down the level of anxiety and nervousness that founders have because like this first meeting is not going to be our last meeting, right?
Mm-hmm.
This first meeting is not going to be me. I walk away and like write you a check and wire you money, right? It's going to that takes a little bit more time. It doesn't have to take a lot of time, right? But there's going to be multiple meetings. There's going to be due diligence. There's going to be all these other things. So for a first meeting, let's just get to meet. Let's get to know each other a little bit, right? Let me ask you some questions to get to understand your business, and you can ask me all the questions you want. Like it's the founders meeting when it comes to me. Like we can take it however you want. And typically in those meetings, pretty quickly I can figure out, what stage this founder's at. And depending on the stage they're at, how early they are, or, how far along they are, the meetings very often switch from the founder really trying to talk to me and pitch to me and the founder just having a conversation where I'm giving them advice about their business, right?
Right.
Like I can tell pretty quickly, like, okay, this is probably not something where we can invest in a day. So I'm now going to shift the framing of this conversation to let's talk through how you can get some customers. Let's talk through, what things you can do different in your business. Let's talk through, hey, if you're trying to raise money, why do I think you're having a hard time raising money? And what are the things that I think you could do to put yourself in a better light? And so that's kind of how I like to take the first conversations.
That's really helpful. So you talked about kind of that founders can choose sort of how the meeting goes and it's their meeting. And I sort of love that framing. What questions should founders be asking you or other VCs in that first meeting? And I think typically founders don't feel like it's their meeting. They are nervous. But what questions are you expecting them to ask you?
I always expect them to ask me, what's my opinion of the space or what they're working on, which is a question I don't have an answer for. I always tell you, it doesn't matter what I think, it depends on what your customers think, right?
Right.
Don't ever worry about my opinion, worry about the people who are going to pay you. That's the opinions that matter, right? Ask me, about my check size, ask me about the process, ask me how long it takes, ask me what kind of support I give founders post-investment. Ask me, do I do follow-on checks? Ask me if I'm currently writing checks or not, right? And that's not necessarily ask me, but these are the questions you should ask any investor, right? Are you currently writing checks? Do you have the money to make these investments right now? Like, these are questions you can ask in an tactful way, right? Because you as a founder deserve to know. Don't ask me for introductions to other investors, right? Like I typically do that only after I've gotten to know a founder, and if I have a conviction of like, I wish I could make this investment, but I can't. So I'm going to get you to other folks, right? So don't ask me for an introduction to investors, but ask me the introductions to maybe other entrepreneurs, to potential partners, to other folks who may be able to be advisors or help you out that aren't necessarily you're looking for, a check out of that person. Like those, I'm more happy. I'm be a lot easier for me to make those introductions after our first meeting than it is like, hey, Mac, it's been a great conversation. Thank you so much. Just want to ask, do you mind if could you make an introduction to Ben Horowitz for me? I don't know you. No.
Yeah, that's a really good point. And I actually think that's true of angels as well. It's very hard to make introductions at that very early stage. And I'm sure you get asked by so many founders, as do I. So I think that's really great context. As you're kind of going through this process, okay, let's say you've had the first meeting, it went well, you want to learn more. Talk to me about how your diligence process works. What should founders be prepared for in the diligence process?
Yeah, so at RareBreed, our process is pretty straightforward. You have a meeting with me or a member of the team. If that meeting goes well, we'll set up a follow-on meeting with the larger team, right? So it'll usually be 2 to 4 of us where we'll have a longer meeting. We'll dive into some more numbers. From there, we'll let you know, like give us like a week or so to get to a go, no go. If it's a no go, we give you feedback and we tell you why not. If it's a go, we kind of talk lightly about what the terms are and where we think we could fit in the round. And then we start like doing some deeper diligence. Depending on the business, then we'll probably have a follow-up call, one more call with the founder just to dive in over some numbers and actually have something for you to prove those numbers out. Or, we'll start going through a data room. If you don't have the data room, we'll give you a list of things we want to see. And we might do we will do a few customer calls. So we will talk to a few customers to understand how they like the product, especially if it's a B2B product, right?
Right.
Also, we may or may not reach out to some of the people you put on your deck as advisors. We'll do some back channeling that way. Tip for founders out there: don't put anybody on your deck as an advisor who you haven't already asked. Because if I talk to them and they say, yeah, I don't know why I'm on that person's deck, or they say something like, yeah, I really like that founder, but I haven't talked to him in like a year, that's never a good sign. Right?
That's a great piece of advice. Yes, for sure.
Like, be careful with those things. But yeah, so we'll do some diligence, but we try not to over diligence things. We try to move quickly, and we do have the ability to move faster if need be. Like if there's a round that's coming together really quickly, we have the ability to move faster in those cases. But generally speaking, it's going to be like a 5-week, 6-week process from like first meeting to check.
Got it. So should founders, like if they have not been talking to sort of others, maybe you're one of the first VCs that they've talked to, should they come to that first meeting or through this process with an idea of valuation or terms? Do you prefer when founders come in and say, yeah, it's not like we don't have a lead, or, we're just starting to raise, but we're going to raise $750,000 on, with a 5 million cap on a note? Do you prefer that, or do you prefer founders to kind of come in and say, we're sort of open and, let's talk through it?
I don't have a preference either way. Like, I can work with the founder either way, but like if a founder has some numbers in mind, it at least gives us a starting point. I mean, at the end of the day, whatever they want or whatever they think is going to be a negotiation. So if a founder doesn't know and they want, to talk through it, we'll talk through it. And, hopefully the founder understands I'm going to be as honest and fair and equitable as possible within the confines of I still need to do my job.
Right.
And, founder comes to me with like terms that they already want. We'll work through that so that everybody, at the end of the day, the goal is to make sure everybody's happy, right? The founders got the money they need to execute, and us as investors get our right allocation into a company or the right, percentage ownership, right? A great example of that is there's a founder that we were talking to that was raising $2 million on an $8 million cap, pre-money cap, right? So $10 million valuation. Mm-hmm. But that founder was having a hard time raising the capital, was looking for a lead. And I basically came to the founder. I was like, look, at the stage of your company, the difference between you raising 2 million or 1 million is pretty nominal. Because if you execute and do the things you say you're going to do, you're going to have time to raise more capital. So instead of raising 2 million on an 8 and giving up 20%, why don't you raise 1 million on a 5, give up less ownership, and be able to move faster?
Right.
But on the flip side, being transparent, that also meant for us as VCs, we got a higher ownership percentage in the company. So we got more ownership. The founder kept more of their equity. And so it's a win-win for everybody, and they got the money they needed to go run. Mm-hmm. So, those are the kind of things that happen. And I should say, as an early stage investor, valuations are far more art than they are science, right?
Right.
Like I tell founders, like, hey, don't think so much about how do you like use a spreadsheet or use some kind of calculation to get to a valuation at this stage. That's not how that's going to work. What it's going to be is how much money do you need, or do you think you need to execute on your plan, and how much ownership do the investors want? That's where we start. And then it goes to who has more leverage. If you happen to have a bunch of leverage, well, then you might be able to push that valuation up. If you don't have the leverage, well, then the VC is going to come in and kind of set where the valuation is going to land.
Yeah, that is a really helpful way of framing that conversation. And I think couldn't agree with you more. Valuation at the early stage really is more of an art than a science. And I think founders do forget that sometimes there's a bit of negotiation here and that they should be ready for that. You mentioned though a percentage of ownership, and you mentioned sort of the check size earlier that you write, what sort of percentage of ownership are you looking for in a pre-seed round?
So we don't actually calculate our investments based on ownership. But I mean, if you want to pin me down, it's somewhere between like 5% to 2.5%. It's kind of where we end up landing. But really, the way we think about it is the earliest stages of investing, we know return the highest multiples, right? So that means pre-seed and seed return you the highest multiples on the money you put in.
Yep.
And then as you go up stages from that, the multiples get lower. So the dollar amounts you have to put in have to get higher. And so for us, the way we think about it is we want to put in as much money as possible, as within reason, as early as possible to get the highest multiple. I saw a tweet this morning where somebody said a friend of theirs made $50,000 early stage investment in DoorDash.
Well,
And
that
that
was a good investment.
yes. And so DoorDash ended up exiting at 10,000x the original amount.
Right.
But because of dilution, that person only got 1,000x.
Only.
Wow, 1,000x or 250,000, doing pretty good for yourself, right? And so, like that's what we're looking for, right? Like 250,000 as one of the first investors. If you become a unicorn, we return the fund. If you become a decacorn, we become one of the best funds in our vintage year, right? Typically speaking.
Yeah.
So for us, it's about how much money can we get in early so we can get the highest multiple, more than just thinking about ownership percentage, because then that means we become less sensitive about the valuation price.
Yeah, I think that's a really great perspective. And I think founders should be thinking about that, certainly at those earliest stages. And I want to wrap it up now with kind of one last question, which is sort of, you've given a lot of advice here and tips for founders, but what's the one most critical piece of advice that we haven't talked about that you would give founders as they go out to raise from VCs at the pre-seed or seed stage? Is there anything that you would really tell founders that they really need to know before starting this process?
One, don't go out to raise too early. Try to be, the more established your business is, the more traction you have, the more you figured out about your customers and your customer acquisition and retention, the better and smoother your fundraising process is going to be. At the end of the day, we as VCs, what we do is we give you rocket fuel, right? And so the rocket fuel is to help you go faster. Well, if you come to me with a rocket ship with no wings, like I give you all the fuel in the world, but it's not going to fly, right?
Mm-hmm.
So the more you're doing, the better. Be prepared for a lot of no's, right?
Yeah.
This process takes time. You're going to learn throughout. You're going to get better throughout. Your first pitch is probably going to be terrible. It's okay. It will get better. You will get a bunch of no's. One, understand that that's part of the process. We all go through it. Even VCs, when VCs have to raise their venture funds, they have to go to people and raise money from people, and they get a bunch of no's too. The only difference is the average seed round takes about 3 months to raise. The average venture fund takes 18 months to 24 months to raise. So we have to take no's for a much longer period of time.
Right.
So understand that. And also, because you get a no, that's more often than not a no right now, not just a no in general. And it's not something for you to take personal. No VC is ever going to give you a no. Well, I'm not going to say no, but generally speaking, you're not going to get a no for an investment because the VC just doesn't like you, right? It's just not a good time. It's not a good fit. It's not right now. There's more for you to do. Take some advice, kind of a thing. And so don't take it personal and try not to be defensive. I know that can be hard. You're in front of somebody pitching them your baby. This is your baby. This is what you're working on. This is like your life's work. And for somebody to tell you no, that doesn't feel good. It hurts, right? But try not to take it personal. Try not to get defensive, because there are plenty of founders that I've ended up investing in much, far later after our first meeting. And I'm telling you, if in that first meeting you lash out at me, or you call me names, or you try to shame me into doing something, or you want to tell me, well, screw you, Mac, I'm going to make it. You don't know what you're talking about. That's not going to be helpful. This is not helpful for you. This is not helpful for me. These are small communities. At some point along the line, somebody's going to ask me something about your business. You don't want me to have a negative perception, right? Like, but I get the human element of it, right? So I'm not going to be the ones going to be like, yeah, that founder cussing me out, and that founder like hated me, so I can never talk to him again. But there are VCs who will, right? Understand, we're all people. These are human relationships, right?
Yeah.
So if you get a no, take it as a chance to get as much information back as you can. Why did they say no? What feedback do they have? What could you change? What would they like to see in the next 6 months? Don't say like, don't ask for advice. And then, 2 weeks later, like, hey, you gave me that advice and I did these things. Like, you're not going to be able to do enough, generally speaking, in 2 weeks to be able to show that you taking the advice, we're able to move the company forward. In rare occasions that happen, but generally it's going to be, a quarter or two, if not longer, before you start to see some real difference. And so, take it as a chance to learn. And if the investor doesn't give you any real feedback, don't take that as a slight either. That's just a strategy that some investors use, right? And it's a strategy they use because at the end of the day, every investor is making a bet on you. It might feel like they're being vague and uncommittal, but really it's them making a bet of saying, hey, I'm afraid to say something that's going to make this founder upset, because I believe that this founder has potential sometime in the future, either with this company or another company, to do something amazing. And so I wanted to remain on good terms with them so that I can make an investment in the future.
Right.
So that is a strategy that a lot of investors use. I don't. I'm going to tell you how I feel and be honest about it, right? But not every investor is, and it's because of that strategy. So don't take those things personal. Just know this is part of the process, and it's not the end of the world, and that investor may end up being a really valuable asset to you. If not today, could be years in the future.
That's really great advice. And I think it's, one of my early bosses said to me that it's a small world and a long life. And I think that's what you've just encapsulated there, that you never know when you'll meet these investors or people who've said no to you again in the future, or if there's an opportunity to get investment later, or even references or help, or be asked to come speak at one of their events. You just never know. And it's always good to leave on good terms no matter what. So very much appreciate that advice. And Mac, thank you so much for sharing all of this on the podcast today. It was really a pleasure to have you.
Absolutely. Thank you for the invite. This was fun. And hopefully the audience got some nuggets out of it.
They definitely did. I can say that in advance. And thank you, audience, for listening to the Retail X podcast. We'll have another new episode out shortly. Thanks for listening. If you'd like to attend a Retail X Series event, check out www.retailxseries.com for upcoming virtual events and recordings of past events. You can also follow us on Twitter and Instagram at Retail X Series. You can also learn more about me, find fundraising resources, or submit a pitch deck at www.redgiraffeadvisors.com. Thanks, and catch you next time.